Hi all, welcome to i-tutor Academy. In today's session, we will start with Unit 4, MMPC 010, that is Demand Concepts and Analysis. So what are the objectives of this unit? So define demand and its determinants and explain the law of demand, identify difference between Fame's demand curve and market demand curve. Structure is introduction, the demand function, the law of demand, market demand curve, the determinants of demand, the product's price as a determinant of demand, income as a determinant of demand, taste and preferences as determinant of demand, other prices as determinants of demand, and other determinants of demand. Summary, keyword and self-assessment questions. These are the structure of this unit. So first of all, we will start with the introduction part. Demand refers to the quantities of goods that consumers are willing and able to purchase at various prices during a given period of time. For your demand to be meaningful in the marketplace, you must be able to make a purchase. So that is, you must have enough money to make the purchase. So there are no doubt many items for which you have a willingness to purchase, but you may not have an effective demand for them because you don't have the money to actually make the purchase. Okay, so here is an example. Please go through it your IGNOU study material. And for demand to be effective, a consumer must also be willing to make the purchase. So there are many products that you could afford, that is, you have the ability to buy them, and but for which you may not be willing to spend your income. Each of us has a unique perspective on our own personal satisfaction and the things that may enhance that satisfaction. The important point is that if you do not expect the consumption of something to bring you added satisfaction, you will not be willing to purchase that good or service. Therefore, you do not have a demand for such things despite the fact that you might be able to afford them. And when we discuss demand, we are always referring to purchases made during a given period of time. Okay, so example also here. Please refer your IGNOU study material parallel this classes, so it will help you more. Okay, and uh, if these things give us satisfaction, we say that they have value to us, and used in this way, value implies value in use, and air has a value in use because we benefit from breathing air. Okay, so that is about the satisfaction and demand. And we all have a limited amount of money that we can exchange for goods and services. The limit varies from individual to individual. For example, a school teacher typically has far less money to spend than a successful investment banker. So that is the difference. Okay, next is the demand function. What are the demand function? The demand function sets out the variable which are believed to have an influence on the demand for a particular product. The demand for different product may be determined by a range of factors which are not always the same for each of them. And the presentation in this section is of a generic demand function, which includes some of the most common variables that affect demand. Okay, so for any individual product, however, some of these may not apply. This any attempt to buy the fame to predict demand for a product on the basis of the demand function will require some initial knowledge or at least informed guesswork about likely influence on it. So here is the function. Demand function can be written like this. Okay, so here is the variables. So they are own price of the product, that is PO, own price of the product, and price of complements, that is PZ, and price of substitute, that is PS respectively. And the fourth variable is the demand function, that is YD, stands for disposable income. Okay, so this is YD, transport disposable income. So that is the amount of money available to people to spend. The greater the level of disposable income, the more people can afford to buy, and hence the higher the level of demand for most product will be. And the effect of changes in disposable income on the demand for individual product will of course be determined by the way in which it is spent. And this is where the fifth variable, that is taste, need to be taken into account. Over a period of time, taste may change significantly, but this may incorporate a wide range of factors. Okay, so example is here. And the next set of variable, the a variable, relate to level of advertising, representing the level of on product advertising, the advertising of substitute, and the advertising of complements, respectively. The relationships here are as follows. Okay, so in general, the higher the level of on advertisement for a good, the higher demand for that good would be expected, other things being constant. Likewise, the higher the level of advertising of a complementary good, the higher the demand for it, and the goods which it is complementary to will be given their symbiotic relationship. And conversely, however, the higher the level of advertising of a substitute good, the lower the demand for the good for which it is an alternative, and people buy more heavily promoted goods. And the overall effect of the advertising will depend on the extent to which each of these forms of advertising is used at any given point of time, as they may, at least in part, and cancel each other out. And this is something the firm will also need to know in order to determine its optimal advertising strategy. Okay, the variables CR and R are also related. The former represent the availability of credit, while the latter represent the rate of interest, that is the price of credit. And this variable will be most important for purchase of consumer durable goods, for example cars. Someone's ability to buy a car will depend car will sorry buy a car will depend on his or her ability to raise money to pay for it. And this means that the easier credit is to obtain, the more likely they are to be able to make the purchase. At the same time, credit must be affordable, that is, the rate of interest must be such that they have the money to pay. These two variables have traditionally been regarded as exogenous to the fame, that is, they cannot be controlled by it. And in recent years, however, major car manufacturers have increasingly sought to bring them under their control through the provision of finance packages. And the letter E in the demand function stands for expectations. Okay, this may include expectation about price and income changes. Okay, example is here, please go through it. And the variable n, and each variable have their own functions. Okay, number of potential customers. And finally we come to zero, which represent any other miscellaneous factors which may influence the demand for a particular product. Okay, and thus each product will have its own particular demand function, depending on which of the above variable influence the demand for it. The ways in which the level of demand can be estimated on the basis of this demand function. Okay, so this we will discuss further in blocks unit 6. Okay, so this is unit 4. Unit 6 we will discuss further. And the next subsection is the law of demand. What is law of demand? For most goods, the consumer are willing to purchase more units at a lower price than a higher price. The inverse relationship between price and the quantity consumers will buy is so widely observed that it is called the law of demand. Okay, the law of demand is the rule that people will buy more at lower price than at a higher price if all other factors are constant. This idea of law of demand seems to be pretty logical and accurate description of the behavior we would all expect to observe, and for now this will the suffice. The law of demand states that consumers are willing and able to purchase more units of good or services at lower price. Okay, price and quantity is proportional, and than at a higher price, and other things being equal. Have you ever thought about why the law of demand is true for nearly all goods and services? And two influences known as the income effect and the substitution effect are particularly important in explaining the negative slope of demand function. And the income effect is the influence of a change in a product's price on real income or purchasing power. If the price of something that we buy goes down, our income will go up further, and we can purchase more goods and services with a given level of money income. The substitution effect is the influence of a reduction in a product's price on quantity demand, such as that the consumer are likely to substitute that goods for good for others that have thus become relatively more expensive. The concept of demand is often depicted in a graphic model as a demand curve, and a demand curve is a graphical illustration of the relationship between price and the quantity purchased at each price. When plotting a graph for demand, the price is measured along the vertical axis, and the quantities that would be purchased at various prices are measured along the horizontal axis. So, this is the demand curve. Okay, so here is the price, and this is quantity demand. So, this is D. Okay, so this is the demand curve. And the same information can also be given in table or demand schedule, such that is a table. This is the same is the here demand schedule. Okay, so if price is 90, the quantity is 40. The price is 70, the quantity is 120. When price is if just 10, this the quantity is 360. So this is the relationship between price and quantity. Okay, so this is all about today's section, and next subsession we will discuss on next video. We just started our unit 4. Please refer. In between any doubts, you can contact anytime. And for more MBA series, you just do like, share, and subscribe our channel. Thank you so much.
i-tutor Academy presents IGNOU MBA Complete Syllabus Coverage Classes for individual students, semester-wise subject with online flexible timing. For more details, contact on +91 623 827 1885